All right, let's talk about something every single investor has to deal with: taxes. More specifically, how does Canada tax the money you make from your investments? Because, it's not just about what you earn, it's all about what you actually get to keep.
So you've done the smart thing. Your investments are growing, which is fantastic. But the big question is, how much of that growth is really yours? The tax man always wants a piece of the pie. And honestly, understanding the rules is the absolute key to maximizing what ends up back in your pocket.
In the world of taxes, this is what's called property income. It's basically the money you make passively from your assets. We're going to break down the three big ones. You got interest from things like bonds or GICs, dividends from your stocks, and of course, income from rental properties. And spoiler alert, each one is taxed in its own unique way. Okay, let's kick things off with interest income. When it comes to taxes on interest, it's really all a game of timing. It's not just how much money you make, it's about when you have to report it. And the rules are different depending on whether you're an individual or a corporation. And you can see the difference right away. For a corporation, the rule is super strict. You have to report interest income as it's earned, like every single day. There's zero wiggle room. But for us regular individual investors, we get a bit more flexibility. Which sounds great, but yeah, there's always a catch, isn't there? And here it is, the big catch. While you have some choice, you can't just delay paying tax forever. There's this rule called the anniversary day accrual method, and it basically forces your hand. The bottom line is, at least once every year, on the anniversary of when you bought the investment, you must report all the interest that has piled up. So that rule really limits how long you can put off paying that tax.
Next up, dividend income. Now, this is where things get really fascinating because the tax system has to solve this fundamental puzzle. How do you avoid taxing the exact same dollar of profit twice?
So think about it. A company makes a profit and it pays corporate tax on it. Then it takes that after-tax money and pays it out to you as a dividend. Then you have to turn around and pay personal income tax on that dividend. See the problem? That original profit just got taxed 2 times. Canada's solution to this is actually a pretty clever 2-part system.
Part one of this solution is called the gross up, and honestly, it's a bit of a head-scratcher at first. You actually have to report more income on your tax return than the cash that landed in your bank account. Depending on the company, you'll report either 115% or 138% of the dividend. And you might be asking, why? Well, the idea is that this grossed-up amount gets you back to what the company earned before it paid its own taxes. But part 2 is where you get the payback. It's called the dividend tax credit. This is a credit that directly chops down your personal tax bill. The logic here is that the credit is designed to give you a break for the taxes that the corporation has, in theory, already paid on those earnings. Okay, let's make this real with an example, because the numbers really help. Let's say a company earns $1,000. It pays, say, $130 in corporate tax. That leaves $870, which it pays out to you as a dividend. On your tax return, you gross up that $870 back to the original $1,000. Now, let's imagine your personal tax on that would be $500. But then you get that dividend tax credit for $130, the exact amount the corporation paid. So your net personal tax is only $370. The double tax problem? Solved. Pretty neat, right? All right, our last category for today, rental income. If you're a landlord, you know the name of the game is all about deducting expenses to lower your taxable profit. But there's one really big deduction that comes with a very, very important rule you need to know about. So yeah, you can deduct a whole bunch of costs from your rental income. You've got mortgage interest, just the interest, not the principal, property taxes, insurance, repairs, all the usual suspects. But then there's a big one called capital cost allowance, or CCA, and you can just think of this as a deduction for the wear and tear on the building itself. Yep, CCA is basically the tax world's word for depreciation. It's the government's way of saying, hey, we get it, your building is a capital asset and it's getting older and losing value over time. And for a residential building, this can be a huge annual deduction that can really slash your taxable rental income. So this brings up a pretty smart question. Let's say your rental profit is pretty small. Could you just claim a massive CCA deduction, turn that small profit into a big rental loss, and then use that loss to lower the taxes you owe from, say, your day job? Well, the government thought of that one, and the answer is a big, hard no. This is the big rule to remember. You can absolutely use CCA to wipe out your rental profit. You can take it all the way down to zero. But that's it.
You are not allowed to use CCA to create or increase a rental loss. So it's a powerful tool for sheltering your rental income, but it's not a magic wand to shelter your other income.
Okay, so that was a whirlwind tour through the three main kinds of property income. Let's just boil it all down into a quick toolkit so you can remember the key takeaway for each one.
For interest, it's all about the timing game. The key rule? You've got to report that accrued income at least once every 12 months. For dividends, remember the double tax puzzle, which is solved by that whole gross up and tax credit system that ultimately reduces your overall tax. And finally, with rentals, it's the expense challenge. And the number one rule is that CCA, the wear and tear deduction, cannot be used to create a rental loss.
And that really brings us to the final and most important thought. Now that you know the basic rules of the game for each of these income streams, you can start to think strategically. For your personal situation, for your specific tax bracket, which type of income is the most tax efficient for you? That's the question worth digging into.